Hi, it's Jimmy. Before we get on with the interview with Michael Oliver, just a quick reminder, we have a virtual silver conference coming up this Friday, April the 25th at 8 a.m. Eastern Time, where we're going to discuss everything to do with silver. Gold is up 30% on the year, but silver is only up 20%. So what's holding it back and when will it break out? And where is the silver price going? And when will it take out its all-time high of $50 an ounce? These are some of the questions that we're going to be discussing during this 3-hour long event. Once again, it's this Friday, April the 25th at 8 a.m. Eastern. And if you can't join us live, no problem. You can check it out on our YouTube channel, Bloor Street Capital. There's a link below to register. Thank you. Michael, thank you very much for joining us today. How are things in Colorado?
Oh, nice. Spring is coming.
So every day is like walking through a financial landmine. And what I try to do in markets like this is take more of a defensive approach. I'm trying to protect my money as opposed to make money. And so I'm hoping you can help me with that process. And I want to go through various asset classes. And the first one I want to look at is the S&P. We peaked out earlier this year at 6,100. It went all the way down to 4,800. We had a nice rebound up to the 5,400 level. Now it looks like it's under pressure again. So I want to start right here with the S&P. What's your view on the S&P?
Our view on the U.S. stock market, we look at the S&P 500 and the Nasdaq 100 because the Nasdaq 100 is the leader index. Its front end loaded symbols are basically the symbols that everybody chatters about, the Mag 7 type thing. And it led the way up. It morphed since you go back to 2009 bear low. The Nasdaq 100 went up like 18, 19 fold, whereas the S&P went up 9-fold. So, Nasdaq 100 vastly beat the S&P, and it will do the same on the downside. When we're now, as far as we're concerned, we're in a bear trend. That first drop back in January, when we were, in fact, just before we made the high, which is, like you said, over 6,100. A couple of weeks before that, we said, that's it. It's no good. Well, it went up and made a new teasing high, didn't go anywhere, and then started to wobble down. But the Nasdaq didn't break our momentum trend structures. We're not you look at a price chart if you want to. It's usually lagged to momentum. But momentum trend structure broke to the negative direction in early January for the S&P. But it took till late March, mid to late March, for the Nasdaq to do the same. And we wanted it to break because it's the leader. And it broke, like 20,000 to 21,000 zone. Okay. And it's since dropped down to 16,500, just like the S&P dropped down close to 4,800. Well, when that break started, we did some game playing with the price charts, which anybody could with a crayon. You go back and look at what was the high for Nasdaq and S&P at that last major high. For Nasdaq, it was in November of 2021. For the S&P, it was in January 2022. You draw a line across that high. Where was it for the S&P? 4,800 plus. Came down and sat on it and then bounced. Why? Because people could draw a crayon line and buy it there, thinking, oh boy, support. Okay, fine. And Nasdaq 100, its level was about 16,500. Where did it bounce from? 16,500. So not just that, we had some momentum reasons to assume there could be a bounce because we were short-term, not long-term, short-term oversold. So sure enough, we got our bounce. In fact, if you'll get a daily chart out of the S&P, if your viewers will, and go back and look at the low that hit that 4,800 on the S&P, 16,500 on the Nasdaq. The rally that followed is when Trump, I think, went to the 90-day thing, but that was the rally. In fact, when you made your high shortly after that day ended, I think the next morning or something, you never took it out again. The rally was literally one big, huge headline chasing day. And since then, both indices have been stuck below that high, trying to get above it, couldn't do it. Now they're coming back to challenge that low. And we argue if you take the S&P back below that 4,800 by any credible amount, and you take Nasdaq below that 16,500 by any credible amount, then that's when the price folks will start to pull their hair out, say, oh my gosh, support didn't hold. Well, it's idiot support because, again, any kid with a crayon could draw a line across that. Momentum, meanwhile, is broken. It's that little bounce point we expected. They got it. It's hopeful. But the key for the stock market, I think, is not the stock market, is underlying macro fundamentals and technicals that are going on elsewhere. One of them is the dollar. The dollar between 2022 and 23 and into 24 did nothing. If you look at the price chart of the dollar index, it was stuck in about a 7% range, up, down, up. In other words, nowhere land. Therefore, the euro and the yen were in the same kind of sort of nowhere land, because that's what comprises the dollar index. 71% of it is those two. But it was really non-event. So the foreign exchange markets, the big foreign exchange, was not a factor. It wasn't caught making noise. It was the quiet one. We call it, watch out for the quiet one. Okay. The end of March, the dollar index broke under 104 something. And on the price chart, that didn't mean much because the prior lows during 2022, 2023 were all at 100 level. Okay, price chart lows. But annual momentum broke a trend structure at 104, just above 104 at the end of March. Now, 6% drop in 3 weeks. We traded under 98 today. We're at another trigger level for it based on 10-year average momentum. And we've got that chart we can show. And when you look at that chart, you can see, again, the 3-year average oscillator, which is also annual momentum, it already broke. Okay, now we're looking at a 10-year. And if you look back, you can see that zero line on that momentum chart, which goes back to the low that occurred in momentum low I'm talking about, back in that 2021, back in 2018, 19. You use the 10-year average as support. In other words, the momentum bounced off that zero line, says, oh, I got support there, okay? And then you can see by looking at that bottom chart, which is the momentum chart, where you plot each month's close, the dollar index, where is it in relationship to the 10-year average? Is it above it or is it below? So you plot an oscillator. We've traded below that zero line today. The zero line meaning 10-year average. 98.35. We traded down into the 97s. Now, if you close the month out below that 98.35, you've blown the last vestige of support that exists for that currency. There's an open window now to drop another full 20 points just to get back to the lows that occurred 12 years ago, near 70. And I frankly think that's about what's going to happen. That becomes a huge impact creator, wave creator in other markets, which for the prior 2 years wasn't. It was quiet. And then when you go to the T-bonds, this is where it gets really scary, especially for Powell and his gang. They can ignore all kinds of stuff if they want to. Stock market drop, okay, we can ignore that. They can't ignore bad data points. But the data points haven't been bad. And the reason is, if you go back and look at any bull market peak in the stock market, it takes until you're demonstrably into the bear trend before then those data points start going negative in a way that smacks the Fed in the face. But that bond market is a variable that is behaving incorrectly, okay? In fact, it crashed. We had a rally high about 3 or 4 weeks ago up to 122 on the long-term T-bond futures, 30-year bonds. They collapsed within 2 days down to 111. That's it for the T-bonds. That's a crash. That woke up the Fed, even though they can't admit it. You cannot have government debt go into that type of behavior. So they're fully aware of that. But their problem now is that Trump tells them you got to cut rates. And so if they cut rates, they look like, well, who's in charge here? Okay. So, but they know with the T-bond market imploding, and it's now coming back down it got into the 112s again today. They had a little bounce, just like the stock market did, off that puke low of 3 weeks ago. And it's just like the stock market had a little bounce, but now it's starting to weaken too. So that's really the market that would panic central banks the most, especially the US central bank, government debt. So those are two variables that will impact that stock market.
Okay, I just want to ask you one more question about the S&P. That last level we saw was 4,800. Do you think we test that in the coming days? And if so, do we go through it? And if we do go through it, what's the next level on the S&P?
Yeah, I think we're in a major bear trend. I think it's begun. But when you start a bear trend, it's not always just one magic signal from a price structure, or in our case, a long-term momentum structure being broken. It's layered. Go back and look 2000, 2002. I mean, it wasn't A to Z. It was zigzags all the way. In fact, the Fed cut rates all the way down. Didn't stop the market. Or 2007 to 2009. There were many lovely rallies. Fed even did rate cuts all the way down. In fact, they did rate cuts 1 month before it peaked. Okay, that didn't help the market. It helped gold because they're creating money. Okay, printing money. But so don't look for one thing to cause a total implosion. Instead, we break enough structure to where we say momentum says you're broken. Price will then, within a few months, usually finally agree in a way that average Joe can look at a price chart and say, uh-oh, something's broken here. Momentum leads. There is a level below the 4,800 on annual momentum of the S&P. It's only about 3% below there. And we'll get specific, we do with our subscribers. That you break that and all hell could break loose. I don't mean necessarily a crash, which is 30% or 35% in a week or two. But that's when the public is going to realize that, my God, it's not a bargain. It's not a corrective 20% pullback. It's a buy. Instead, something else is going on here. And I suspect when that occurs, the S&P breaks through 4,800 and goes the next 3 or 4%, and then blows the bottom out of another structure. That at that point, you'll look over at the bonds and say, oh, I can understand why. Or look at the dollar, I can understand why. So all these things will coalesce. But yeah, breaking 4,800 is a big deal. Not just because you break that idiot line on the price chart where people bought and made, as I said, one good day of rally and the rest has been below there. But at that point, the public starts to scratch their head and get really worried. I mean, after all, you've already taken away in that drop to 4,800 all of 2024, and you're back to the highs of 2022 in the S&P, meaning 23, 24 was a waste of time. You're back where you were in January of 2022. That's a lot of time wasted to be back at the same level you were from an investment point of view. And for Nasdaq, you're back to the high that occurred in 2021, excuse me. So it's a wipeout that causes a lot of sadness. People with 401ks, oh boy, I got enough to retire, dear. And all of a sudden you just give up 20%. Then you give up 30. My God, your life has changed. So real panic sets in. Those data points will go south in a big way, real fast. And I suspect they'll start showing up in a month or two because of already what's happened. And that's when the Fed will have to give in and look. And unfortunately for them, it's going to look like they did give in to Trump.
Well, I might suggest it might even happen sooner because we have Q1 numbers coming out now. We've already had profit warnings from a lot of companies. Walmart came out and cut their guidance for the year. D.R. Horton, the largest home builder in the U.S., took down their guidance. We've had every major airline cut their guidance. Delta, American Southwest all said both business travelers and also pleasure travelers are not flying because of the uncertainty with this current environment. And I thought this one was interesting. LVMH, the high-end luxury retailer, also came out and said they expect weaker numbers going forward. In Asia, their numbers were down. The revenue numbers were down 11%. In the US, they were down 3%. So not even the rich are spending money now. They're starting to feel some economic pain.
Sure. I mean, when you're uncertain, what do you cut? Discretionary spending. And this is one thing I hear about Apple all the time, or I don't hear about Apple. And that is, oh, the concern is, well, the relations with China, and therefore, they need to produce there, it's cheaper, and so forth and so on. And nobody's talking about the possibility that suddenly parents won't be buying their teenage daughter a new cell phone every year or upgrading every year because Apple introduces new features. They're going to say, I'm sorry, dear, you keep the one you had 3 years ago. We're not going to update for a couple of years. It's unnecessary discretionary spending. That's what could kick like a company like Apple, which nobody's talking about that variable. In other words, the collapse in discretionary spending, which among middle class has probably happened to full extent as possible, and even among the rich. They're saying, hey, dear, let's just cut back. We're a little uncertain here. And they can go down quickly too. Just because you're rich doesn't mean you can't collapse quickly, especially when you're fully exposed to the stock market or your company's fully exposed to consumer demand. So it's a rapid trigger. You're quite right. It could happen pretty quickly. And I wouldn't be surprised you start to see the numbers coming up, next month. And then again, what does Powell do? Well, at least he's got an excuse then and has to say, well, I'm doing it because of this, not because Trump's telling me to. Anyway.
Now, the last time we spoke, you were very concerned about the banks, the US banks. And here in the last few days, we saw a lot of the major banks report their numbers: JP Morgan, Morgan Stanley,
Yeah.
Goldman Sachs. On the trading side, they all reported record numbers because of the volatility that's going on in the equity markets and the other financial markets. They're making a killing from all the trading. But are you still concerned about these banks?
Yeah, because they're secondary. They're not a leader, meaning what's going to impact them are things that you just talked about. Companies outside the financial arena who have debt, they're the lenders. So, it's not them as such. It's what goes on elsewhere. Like we're watching commercial real estate in particular, because we know it's a heavily debt-laden sector. And that sector looks technically very weak and vulnerable. In fact, if you go back to 2016, punch up a chart of RWR or VNQ, these are ETFs of commercial real estate, been kissing your sister for all those years. It was either side of 100 on RWR, up and down and up and down. And when the market went up and made new highs, taking out the 2022 highs in 2024, S&P, Nasdaq, they didn't. They only got halfway back to their high. So they were very anemic, for obvious reasons. And now they're quite weak again. It's that sector, you start to have this company, that company, et cetera, within commercial real estate suddenly default on debt. And we had a story a week ago, one of the biggest shopping center companies in the country in New York. Forget the name of the company, it doesn't matter. $300 million default. Somebody's eating that. But all you need is like 2, 3 more of those. And suddenly people say, gee, this is a contagion. Well, it's a contagion because of all the things that are going on, that domino, and ultimately they'll domino into the banking sector. Also look at the bank sector just on what happened in that collapse we had 3 weeks ago or so. S&P low, Nasdaq low. Go look at the bank low, KBE ETF for the banks, and look how anemic the rally's been. It was nowhere like the S&P bounce, the Nasdaq bounce. It was very anemic. Yeah, it rallied, but it was anemic. And right now you're trading about 1.5 last I saw, above touching the low you traded on the KBE, which is down around I think 95 or something. I think it's trading 96, high 96s today. So it doesn't look too good. It bounced with the market, but it's very anemic bounce. And it was, I think, down less than the market today, but still, it's very close to its lows. So again, all these things factor in together, and the causative factors are, not really a stock. It's the business that we're talking about. Consumer discretionary spending collapsing. If that continues, that's disastrous. Also, that affects what? No doubt, commercial real estate, shopping centers, etc. And any company planning to expand its business facilities and using commercial real estate company to do so, to create an office complex that's tech savvy office complex. There's companies that do that are computerized centers and so forth. But so it's all kinds of dominoes here.
Yeah, to your point earlier, there's a lot of layers to peel back. So I just want to summarize a few of the points you've made. Okay, so first of all,
Okay.
with regard to the S&P, we get up to that 5,400 level. We've been pulling back. You're very concerned about the 4,800 level. You think we can go through it. In terms of bonds, you're very concerned here. I think you said the level on bonds is 112.
Well, you get down in a report we did for our subscribers a week ago, we defined some levels that we're not back down to, but those levels that we saw in that break, just look at a price chart of T-bond futures. We do ETFs of TLT, for example, the 20-year bond ETF, and go back and look at that low. You don't want to go back to that low again, because next time you go there, you're going to break some stuff that isn't just the price low. You even get near that low, you're going to be breaking some momentum stuff that says, uh-oh, that bounce didn't hold. It was just an oversold bounce. And that's the kind of market that the Fed really cares about. I mean, they can turn their nose up at NVIDIA, but you start breaking the US government debt market, uh-oh, that's when they go into panic mode. Well, I mean, what's the chief beneficiary over the decades when the central banks go ape and push the pedal to the floor, either through lower rates than market would otherwise have, expanding the money supplies, doing QEs, gold, and monetary metals. And so if you look at today, even though silver was up less than gold, all the monetary metals were up, the miners were up, very little else was up, period. How come they were up? They're supposed to go down with the stock market, we've been told. Remember? Okay. It's not true. Okay. Anyway, so I think investors are just now beginning to realize that hey, gold, and now suddenly you go to the financial TV channels, they're actually talking about it every day. Used to be they'd hardly ever talk about it.
So you mentioned the Fed a couple of times, and I just want to have a deeper discussion on this. And Jay Powell has expressed a lot of concern around the uncertainty associated with tariffs. And he said he doesn't know what to do.
Yeah.
Now, the president has not taken too kindly to this. And
Well, yes, one accusing the other, not cutting the other, said, you're causing this with your tariffs. Yeah, it's back. I love it.
So the president's rhetoric is really starting to heat up. And in fact, he
Yeah.
calls Jay Powell Mr. Too Late. And he also referred to him as a major loser. I'm sure that's the first time in the history of
Yeah.
the United States that the president spoke that way to the chair of the Fed.
So
But what do you think Jay Powell does? You
I
mentioned
don't
earlier
know.
he's already
It
backed
could be
into a corner.
that argument there could be a delaying factor for Powell, because he's got to have justification other than simply Trump said to cut rates. He's got to have some bad numbers. That means he's got to literally wait for some horrible data points, unemployment numbers, all kinds of other data points they look at. They need to have some dark numbers. And so they can say, our other mandate is in play now, the economy and unemployment. Otherwise, he's given in to Trump. So that means if he might have done it earlier, otherwise, he's not going to do that. So he will definitely delay. That's fine. It doesn't matter. We showed charts of 2000, 2002 S&P and 7 to 2009 the S&P, and put arrows on the charts all the way down. Arrows were the Fed cut, Fed cut, Fed cut, Fed cut, Fed cut. It didn't mean anything. It meant something to gold. It didn't rescue the stock market, because once those bubbles break, the bubble takes over. The central bank is merely a road bump in the process of liquidating the bubble. And we right now have the biggest stock market bubble in US history, both in duration of time, time spent, and percentage gains. So welcome to the party,
So Jay Powell, or we have another Fed meeting coming up in the first week of May. That's only 3 weeks away. In all probability, they're not going to be able to do much because we're not going to get a whole lot of information between now and then.
Yeah.
So you're of the mind
I have no idea. I don't predict the Fed. I just know that historically, when you go back and do your homework, it doesn't matter. When they start cutting rates after a period of pause, they may raise rates for a couple of years, then they pause, and when they start cutting, the market starts down, or have already started down, and it doesn't help the market historically.
In other words, it's too little, too late. They're way
Too little,
behind
too
the
late. The
curve.
fire started. You're not going to put it out with a tiny hose. They'll have to go to QEs, and those won't work either. Even when they did, if you go back and look, we did a study of this because everybody has this burnt in their memory. Oh, if the stock market goes down, big gold will go down. There's one month that's got everybody concerned, and that was October of 2008. The S&P dropped 30% that month, meaning a crash event. But that was already a full year off the high. It had been going down hard for a total year. And then finally, a month after Lehman went under in September 2008, the S&P puked 30 some odd percent. That's when Bernanke came in, took the little Japanese trading book, QE, and deployed it. And in November, 2 months after Lehman went under, and a month after the stock market puked, already a year into a bear trend, he finally did QEs because rate cuts hadn't been working. And you know what happened in November? Stock market went down hard again, and it kept going down till March of the next year. 30 more percent drop, even after he did QEs. What happened to gold? In October, it did have a sell-off. It was a corrective, brief sell-off in August, September, especially October, where it needed to correct. It had a huge move at that point. Even while the first year of the stock market had been going down, gold's still going up. It was only in that later part of 2008 that finally the stock market had a puke that gold said, oh, I need to correct anyway, and it had a very bad month. But when they did QE, stock market went down another 30%. Gold exploded in November when they did the QE and was back to its highs by early 2009, on its way to 1900. So again, what the Fed does, don't count on it helping the stock. In fact, when they start cutting rates, panic because they're admitting, okay, that's when they scream. Okay, so they're late to the game. But when they start doing what the head of the Boston Fed, the woman who's head of that, spoke Friday a week ago and said, we've got various tools to employ if things start to happen like that. And she meant not just rate cuts, like QEs. So that was an admission that was quite revealing.
Okay, Michael, so we discussed what's not working, the S&P bonds, US dollar, they're all under pressure. Let's have a conversation now on what is working. Gold is up 30% on the year. It's hard to believe we're only 4 months into the year and already it's up 30%. And it's like a runaway train. Every day it's up 1, 2, 3%. What's your take on gold here? Has it gone too far too fast? To catch the rest of this interview and to hear Michael's views on gold and silver and where they're going, join us this Friday, April the 25th at 8 a.m. Eastern Time for our virtual silver conference when we do a deep dive on all things related to silver. Once again, that's this Friday, April the 25th at 8 a.m. You can register in the link below. Once again, thank you.